NVIDIA Corp. NVDA Analysis Live Market Update. As I look at the monitors right this second, NVIDIA stock is trading live at $179.78, pushing up by plus 1.57% on the session so far. We are seeing a forceful intraday move that has snapped the price back from the morning lows of $173.68, driving it right up against the $180 psychological resistance level. The market cap currently sits at a staggering $4.4 trillion, maintaining its position as the dominant force in the global equity markets. If you are watching the tape, you can see the volume already crossing 81 million shares, indicating that this isn't just retail chatter, this is heavy institutional rotation happening in real time. Most people looking at this chart today are expecting the typical AI fatigue narrative to set in. The expectation on the street, whispered in forums and echoed by contrarian pundits, is that NVIDIA has run too far too fast and that the valuation is disconnected from reality. Investors are nervously eyeing the $180 mark, expecting a rejection that sends the stock tumbling back to the $160. They see the massive run-up and assume gravity has to take over eventually. The reality, however, is far more aggressive and frankly terrifying for the bears. What we are witnessing isn't a bubble deflating, it is a fundamental decoupling of NVIDIA from the rest of the semiconductor cycle. While the expectation is that hyperscalers like Meta and Google will cut spending, the reality is that NVIDIA is embedding itself deeper into the very architecture of chip design itself. Just recently, NVIDIA announced a massive $2 billion investment in Synopsys, a move that signals they are no longer just the hardware provider. They are securing the software infrastructure that designs the chips of the future. This is a vertical integration play that the market hasn't fully priced in yet. While retail investors on Robinhood app are worried about a single-day red candle, the smart money is looking at this Synopsys deal as a checkmate move against competitors trying to build custom silicon. The expectation is a hardware peak, the reality is a platform monopoly. Let's break down the immediate price action we are seeing today. The stock opened at $174.76, dipped slightly, and then ripped higher. This kind of V-shaped intraday recovery is a classic signal of algorithmic buy programs kicking in at key support levels. When you see Tesla stock or Apple stock wavering, but NVIDIA holding the line, it tells you where the leadership is. The RSI on the daily chart is hovering around 46, which is surprisingly neutral. This is critical because it means the stock is not overbought despite being near all-time highs. It has room to run. If you are using Interactive Brokers trading platforms or utilizing the advanced charts on Fidelity trading platform, you might notice the options flow is heavily skewed toward calls expiring in late December, betting on a breakout past $185. Now let's talk about who is actually buying here. It's easy to assume this is just a frenzy of day traders, but the data suggests otherwise. When you look at the 13F filings and institutional activity, you see that the major players, funds managed by Fidelity Investments and massive pension allocations, are not selling. They are rebalancing. They are treating NVIDIA not as a tech stock, but as a utility. It has become the electricity of the 21st century economy. If you check your Fidelity mobile app, you might see that many Fidelity mutual funds have effectively maxed out their allowable allocation to NVDA, forcing them to buy proxy stocks or hold, simply because they cannot legally own more without breaching risk rules. This forced holding creates a floor under the price point that prevents the massive 20% drops we used to see in the past. But there is a deeper layer to this story. The widespread belief is that competition from AMD or Intel or internal chip projects from Amazon and Google will erode NVIDIA's margins. This is the commoditization thesis. However, the recent earnings report shattered that idea. NVIDIA reported $57 billion in revenue for Q3 fiscal 2026, up 62% year over year. That is not the growth rate of a company facing stiff competition. That is the growth rate of a monopoly. The Blackwell chips are reportedly sold out for the next 12 months. This demand-supply imbalance creates a pricing power that is virtually unheard of in hardware. When you use investing sites to compare gross margins, NVIDIA sits at over 73%. Compare that to the auto industry or even standard consumer electronics, and you realize this isn't a hardware business anymore. It operates with the margins of a high-end software company. I want to pause here and ask you a question about your own positioning. Comment below how many shares of NVIDIA you currently hold, or if you are waiting for a pullback to $150 to enter. I am genuinely curious to see if retail sentiment matches the institutional bullishness we are seeing in the order flow. Let's shift gears to the ecosystem. If you are someone who engages in self-investing, you have probably struggled with how much exposure to have. Do you go all in on NVIDIA, or do you use a robo-advisor? Services like SoFi Robo-Advisor or Schwab Intelligent Portfolios are currently facing a massive dilemma. Their algorithms are designed to diversify, often capping exposure to a single sector or stock. But because NVIDIA is driving the entire S&P 500 return, these intelligent portfolio models are underperforming the simple buy and hold NVIDIA strategy. This is causing a migration of capital. We're seeing more investors pull money out of automated, diversified strategies and moving into individual brokerage accounts where they can concentrate their bets. It's a risky move, but in a market where one company is eating the world, diversification feels like a penalty to many aggressive investors. Speaking of SoFi Invest and similar platforms, the rise of fractional shares has changed the liquidity profile of this stock. In the past, a high stock price might have deterred smaller investors, but now with Robinhood fractional shares and SoFi investing tools, the inflow of capital is constant, granular, and relentless. It acts as a continuous bid under the market. Every paycheck, millions of dollars flow into NVDA $50 at a time. This passive bid is a new phenomenon that traditional analysts often ignore when they scream about valuation multiples. They are looking at PE ratios, while the market is looking at monthly automated inflows. We also need to discuss the geopolitical angle, which is the biggest expectation versus reality friction point for this stock. The expectation is that U.S. export controls to China will cripple NVIDIA's growth. The reality is that the demand for sovereign AI, where nations like Saudi Arabia, Japan, France, and India build their own domestic AI supercomputers, is replacing the lost China revenue. NVIDIA is no longer just selling to tech companies, they are selling to countries. This shift from B2B, business to business, to B2G, business to government, is a massive catalyst. Governments are price-insensitive buyers. If France decides it needs a supercomputer for national security, they don't haggle over the price of a Blackwell GPU. They just pay. This pivot is why the stock remains resilient despite the headlines about export bans. Let's look at the technicals again because the chart today is telling a very specific story. We are sitting right between the 50-day moving average and the all-time highs. This is a consolidation zone, often called a bull flag. If you are an active trader on Interactive Broker Stock Trading or utilizing the advanced charts on Fidelity Trading Platform, you will notice a compression in volatility. Bollinger Bands are tightening. Usually, when a stock like NVIDIA coils this tight after a massive run, the subsequent move is explosive. The options market is pricing in a significantly larger move in early 2026. The support at $173 is incredibly strong. We tested it this morning and bounced instantly. This confirms that there are large limit buy orders sitting right below the current price, waiting to scoop up any dip. But we must address the risks. No analysis is complete without looking at the downside. The primary risk is not competition, but execution. With the Blackwell ramp-up, the complexity of these systems is astronomical. We're talking about liquid cooling, massive energy requirements, and supply chain bottlenecks at TSMC. If there is a delay in shipping or a defect discovered in the new architecture, the stock could punish investors severely. We saw a glimpse of this volatility when Tesla stock missed delivery numbers, and the market is unforgiving of perfection-priced stocks. Furthermore, the antitrust drums are beating. The DOJ and EU regulators are scrutinizing the AI landscape. While NVIDIA is currently the darling, they are one regulatory lawsuit away from a 10% gap down. Investors using Robinhood Investments or Fidelity ETFs need to be aware that regulatory headlines can override technicals in a split second. Comparing NVIDIA to its peers gives us more context. AMD is often seen as the value play, the second source. But in this market, being second is a distant second. The software moat, CUDA, is what keeps developers locked in. It's like the iOS ecosystem for Apple stock. Once you build your AI models on NVIDIA's architecture, switching to AMD is not just about swapping a chip, it's about rewriting your entire code base. This high switching cost is the reality that creates the long-term value. While SoFi stocks analysts might argue for a rotation into laggards, the enterprise spend tells a different story. CTOs are not getting fired for buying NVIDIA. They might get fired for risking a transition to an unproven competitor. Let's discuss the broader market implications. If you hold Fidelity IRAs or a Robinhood cash management account, you are indirectly exposed to this price action. NVIDIA's movement dictates the sentiment for the entire NASDAQ 100. Today's plus 1.57% move